Welcome back to the Explainer. So, if you're the kind of investor who likes to cut straight through the jargon and get right to the actual facts, you're in the perfect spot. Today, we're diving into a pretty technical draft scheme information document. We're looking at the HDFC Nifty Metal ETF, FOF. Now, I know compliance stocks like this can look incredibly dense, maybe even a bit intimidating at first glance. But hey, that's exactly why we're doing this. We're going to break down every critical detail you need to know about this mutual fund offering, step by step, totally neutrally, straight from the source. All right, here's our quick roadmap for today. First, introducing the FOF. Then, evaluating risks and the benchmark. After that, we'll map out timelines, liquidity, and loads. Review the plans, options, and minimums. And finally, check out some smart ways to invest. Section 1. Introducing HDFC Nifty Metal FOF. Let's establish what this scheme actually is. So, this scheme is officially categorized as a fund of fund, or FOF. What does that actually mean in plain English? Basically, it's a mutual fund scheme that pools gathered capital and invests it directly into the units of another mutual fund, rather than going out and buying individual stocks or bonds on the open markets. In this specific case, when you put your money in, the fund managers take that capital and buy units of the underlying HDFC Nifty Metal ETF. You're literally buying a fund that buys another fund. And this whole structure, it serves one core target: capital appreciation over the long term. That's the ultimate goal here. But, as with literally any regulated financial document, it comes with a massive, mandatory disclaimer that we absolutely have to highlight. The doc explicitly states there is zero assurance that this investment objective will actually be achieved. It's a target, guys, not a guarantee. Moving on to Section 2, evaluating risks and benchmark. Honestly, getting a grip on risk is probably the most crucial step before you commit a single dime. So, the obvious question we really need to ask right out of the gate is, just how risky is this scheme? Well, looking at the internal risk assessment, you've got the scheme riskometer and the benchmark riskometer. Notice anything? Both of those gauges are dialed all the way into the red zone. The document officially and very clearly categorizes both the scheme itself and its underlying benchmark as very high risk. It's an objective internal assessment based on how the scheme is built, and they put this disclosure right up front. Speaking of that benchmark, the scheme measures its actual performance against the Nifty Metal Index, specifically the Total Return Index. Now, why that specific index? Simply because the underlying scheme, that HDFC Nifty Metal ETF we just talked about, invests directly in the exact stocks that make up the Nifty Metal Index. Tracking this index gives us the most accurate apples-to-apples comparison to see how well the fund is actually doing. All right, Section 3, timelines, liquidity, and loads. Now that we know what it is and the risks involved, let's get into the operational side of things. How and when does your money actually move in and out? Okay, so there are two distinct phases for getting into this fund. First up is the new fund offer, or NFO period. During this initial launch window, you can buy units at a fixed, flat price of exactly 10 rupees per unit. Then comes the continuous offer phase. The document notes the scheme reopens for continuous sale and repurchase within 5 working days from the NFO allotment date. Once it hits this continuous phase, you're not paying that flat 10 rupees anymore. Instead, you're trading at the net asset value, those NAV-based prices that bounce around daily based on market performance. Now, I really want to draw your attention to this one single, very important number, 1%. For this specific fund, this represents a highly specific cost known as the exit load fee. And that 1% fee, it's completely tied to your holding period. If you decide to redeem or switch out your units within 15 days from the date of allotment, you are going to get hit with that fee. But if you just hold your investment past that 15-day mark, the exit load drops to absolute zero, nil. It's a clear-cut structural mechanism built into the fund to discourage super short-term, rapid-fire trading. Next up, Section 4, plans, options, and minimums. Let's look at the structural choices you actually have to make when you're filling out that application. When you enter the scheme, you're basically looking at two primary paths, both sharing the exact same portfolio. You can go with the regular plan, which is made for investors who want to route their money through a financial distributor or an advisor. Or you can choose the direct plan. And that is exactly what it sounds like. You're investing directly with the asset management company and completely bypassing any middlemen or distributors. But here's a really important catch. regardless of whether you pick regular or direct. Unlike some mutual funds that might pay out income or dividend distributions, this specific FOF only gives you one option, the growth option. What that means is any income earned or profits realized, they stay right there in the fund. They aren't paid out to your bank account, they're continuously reinvested, and all that accumulated value just gets reflected in the growing net asset value.
As for the actual cash requirements, the fund uses what we can call the Rule of 100. The minimum application amount to get your foot in the door is just 100 rupees. What about any extra purchases you want to make later? Also a minimum of 100 rupees. And if you want to cash out, the minimum redemption amount is, yeah, you guessed it, 100 rupees. These incredibly low thresholds are pretty clearly designed to make this scheme super accessible to almost anyone.
All right, final part, Section 5, Smart Ways to Invest. The scheme information document doesn't just tell you how to buy and sell manually, it also lays out some special facilities to automate the whole process. So the doc outlines a few of the well-known industry standards. We've got your classic systematic investment plan, the SIP, for investing fixed amounts at regular intervals. There's also a flex SIP, which lets you invest variable amounts at predetermined intervals based on what the market is doing. If you're looking to take money out, they offer the Systematic Withdrawal Advantage Plan, or SWAP, for fixed or variable periodic withdrawals. And for pure convenience, they have a one-time mandate, or OTM. This basically lets you authorize your bank for automatic debits up to a certain limit, so you don't have to manually approve every single transaction. It's a real time saver.
But check this out. The document also highlights a pretty unique feature called the Choti SIP facility. This is a highly specialized entry point, and it is strictly exclusive to first-time individual investors in the mutual fund industry. Literally, absolute beginners. If you've ever initiated a SIP or made a lump sum investment in any mutual fund before today, you are completely disqualified from this specific facility.
On top of that, there's a neat compliance carve-out for what the document calls a micro SIP. This facility actually allows investors who don't hold a PAN card or who are officially PAN exempt to invest either via lump sum or SIP, up to a hard cap of 50,000 rupees per year per investor. It's a very precise regulatory provision spelled out right there in the paperwork. So we've journeyed through the mechanics, the very high-risk profile, the timelines, and the varied entry plans of the HDFC Nifty Metal ETF FOF. Now the final step isn't written in the document. It's entirely up to your own strategy. Based on this direct breakdown, you've got to ask yourself, does your personal portfolio actually require this kind of targeted, high-risk, long-term exposure to the metal sector? That is the ultimate question that only you can answer. Thanks for tuning in to The Explainer, where we turn dense documents into clear understanding. Keep learning, and I'll see you next time.